Good morning and welcome to Stock Market Today for Thursday, August 8th, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. So U.S. equities were mixed in Wednesday's trading after rallying back from early losses. Material staples and REITs outperformed while financials and energy lagged. Treasuries were stronger as global bonds moved higher. There's a big theme yesterday was the rally in global sovereign bonds. Dollar was down on the yen cross, little changed against the euro. Gold finished up 2.4%, settling above $1,500 per ounce for the first time since 2013. WTI crude down 4.7% after an unexpected U.S. inventory build. As we get to the desk this morning, however, futures are up 30 basis points after U.S. equities held Monday's lows in yesterday's trading. And I think that's important. That's a key level to keep in mind. Asian markets were mostly higher overnight, with China up nearly 1%. European markets are moving higher as well. Treasuries are weaker with some curve steepening after yields ended well off their lows for the session on Wednesday. The dollar is weaker on the major crosses. Gold down 70 basis points following a 4-day winning streak. WTI crude is up over 2.5% on the heels of a sharp 3-day pullback. Some commentary that Saudi Arabia is going to do whatever it takes to get the price of oil higher. Let's take a look at the S&P 500 now. Past couple days, we've been showing that Fibonacci retracement level. We're going to remove that today and just highlight the fact that we seem to be building a base around the 2850 mark. Now, I see support in the 2800 to 2850 zone, which we have highlighted here, which is just above the rising 200-day moving average. Resistance is in the area between 2900 and 2950, which holds Monday's opening gap. Friday's low, 2915. Opening gap at 2,900 on Monday. We will see how the market reacts here. That gap is just overhead. We're watching the character of the RSI for clues. If we trade into the 2,900, 2,915 gap and the RSI can't get out of bearish ranges, that's a signal that you're going to want to raise cash, in my opinion. Not go to cash, but raise cash. Low conviction positions. Maybe look to hedge your portfolio a bit. Chaikin money flow is still bullish, but to me right now, most important attribute is how the market reacts as it trades back into that gap. And in particular, what is momentum telling us? If we easily fill the gap and the RSI breaks back into bullish ranges, well, then we have some information there that we can use as we start to put together our thoughts and ideas going forward. But right now, that's the key area. So far, holding 2850 is a positive first development. Taking a look at your market in a minute. What am I talking about in my note to Chaikin Analytics clients today? Stocks reverse early losses to finish near the highs. We hit on that. U.S. Treasuries participate in a global bond rally. It was really something yesterday. Across the board rallies in the prices of sovereign debt as central banks around the world continue on an easing path. However, I will note that in the U.S., yields did finish off their lows of the day. So just something to keep in mind. The trend is down, but I don't necessarily think you want to chase bonds here. Short-term breadth metrics neared oversold levels this week. Low volatility benefits in a high volatility environment. We'll talk about what that means a little bit later in the show. Futures point to a higher open today, as I said. Power bars for the major indices still mixed with a bearish skew. 2-to-1 bears to bulls for the Dow, which was relatively flat yesterday. S&P 500 seeing a little bit of an improvement, but still skewed in favor of the bears. 124 bearish or very bearish stocks, 83 bullish or very bullish stocks. NASDAQ outperforms on the day, but still skewed in favor of the bears. Only 18 bullish stocks, 30 bearish stocks. Small caps are relatively even. 367 bulls, 370 bears. Notice underperforming once again. Bonds rallied. Materials were the big sector yesterday, up 1.4%. I've talked about how I've been warming to that group, and we're starting to see some relative strength come into that group. Right now, power bar ratio, though, skewed in favor of the bears, 3-to-1. According to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bearish. Major indexes are mixed. Taking a look at our stock of the day now. American Financial Group from the insurance industry, which we have liked. You know that. Closed at $100.77 yesterday, up 73 basis points. Power gauge rating is very bullish due to very attractive financial metrics, very strong earnings performance, and very positive expert activity. Stock also has some strong price volume activity. 20 factors, 5 in each of these 4 categories give us that very bullish rating. Strong trend, strong industry group. But you can see it's a bit of a mixed bag here, right? I wanted to drop down the checklist and show you why this is a mixed bag. Power gauge rating's bullish, right? Great. But what do we want? We want bullish and outperforming, not or outperforming, bullish and outperforming. That is a great stock, or could be a great stock, right? We are oversold. Long-term trend weak. Long-term trend line is starting to turn down, and money flow persistency is neutral as we've dipped into bearish territory here. So this really is a mixed bag, and it's a great example of how when you're looking at the chart, you might tend to be a little subjective. You might tend to focus on the things you want to focus on to get you to pull the trigger on a trade. But if you want to be objective and see if the weight of the evidence supports getting involved, you drop down our checklist and you can see objectively that this is a mixed bag at best. It's not a name we want to get involved in right now. I think we want to add it to a bullish watch list, see if it improves, see if we get the green lights. Then the weight of the evidence supports considering a trade in that stock. Sector tracker now, looking at the movement of the major sectors over the last 5 days, and it still has that defensive feel at the top, doesn't it? Real estate and Utes benefiting from number 1, defensive rotation, and number 2, an offshoot of defensive rotation, the fact that yields have collapsed to the points that they have. Staples and healthcare, traditionally defensive sectors of the market, down over the last 5 days, but outperforming. Middle of the road, materials, discretionary, comms, and industrials. Tech, fins, and energy at the bottom of the list. Tech, obviously trade sensitive. Financials, obviously interest rate sensitive. And energy has just been an utter disaster. We've been table pounding bears on energy for months now. Now, what I will say is we want to pay attention here a little bit. Just given the commentary out of Saudi Arabia and oversold conditions for the group, I don't necessarily think you want to go out and open bearish positions in the energy sector now. I think if you have bearish positions, you might want to think about booking some nice profits and then looking for opportunities to reopen when energy becomes overbought, all else being equal. But commentary out of Saudi Arabia, clearly the decline in the price of oil has caught their attention. So near term could see a little bit of a backup, a little bit of a relief rally in energy. Our industry in focus today, mining services, which over the past 6 months has been a massive underperformer. By nearly 18%, it's underperformed the S&P 500. However, potential shift going on as the power bar ratio, which measures future potential, is very strong. 6 bullish or very bullish stocks, only 2 bearish or very bearish stocks. The group is ranked number 3 of 21 subsectors. Top 2 are insurance and aerospace and defense. 2 are the areas where we've been screaming bulls. This group here has moved up 3 slots over the past week. Some indicative names: Reliance Steel, AK Steel, and Worthington Industries. RS, AKS, and WOR, respectively, have very bullish, and bullish Chaikin power gauge ratings. Let's take a look at Reliance because I think we're close to a setup. Keep an eye on Reliance over the next couple of days. It's a very bullish stock, strong trend, strong industry group, beginning to outperform the market and nearing an oversold condition. Chaikin money flow is bullish, and you can see here just from a classical technical perspective, resistance at 95. Breakout, pullback, test and hold. Old resistance becomes support above a rising long-term trend line. I think you're going to have an opportunity here for a bullish trade in Reliance Steel, RS. Add it to your bullish watch list. If you're aggressive and want to get involved today, I don't love it. Just given the choppiness in the market, I'd rather see this oversold. Wait a day, see if we get to an oversold condition. Or if we don't get to an oversold condition, see if the indicator starts to round higher. But either way, I think Reliance is interesting. Taking a look at our trending names now. Yesterday's S&P 500 gainers and losers. FleetCor, recent bullish idea for us, up 8.2% following earnings. AIZ, insurance stock, 7.5% on their print. CVS beat estimates, sent the stock higher, 7.5%. Kroger didn't see any real news, 7%. Microchip EPS beat, 3.95% to the good. Abiomed continues to bleed out, 5.26%. Disney's earnings sent that stock lower by 5%. Silicon Valley Bank didn't see any news there, 4.71% to the downside. Schwab trades to a 52-week low, 4.6% to the downside. And CFG didn't see any real news there, 4.5% to the bad on the day. And it is still earnings season. So let's take a look at some surprises. Interactive beats by 27 cents. Stock traded higher yesterday. I would also note that Match, which is spun out of Interactive, also trading higher yesterday. There's AIG, beat by 26 cents. CVS Health, beat by 19 cents. Monster Beverage missed. In fairness, that was a recent long idea for us. Stock is trading lower. So I call out the good ones. I'll also call out when we miss, but that's why we advocate for managing risk and using stops. Fox beats by 3 cents. Reporting today, KHC, Kraft Heinz before the open. After the close, Activision and CBS widely followed. Neutral stocks before the open, Viacom, Norwegian Cruise, and Perigo. After the close, take a look at News A. Symantec reporting but trading higher here on potential takeout. No bearish stocks reporting today. Let's take a look at what we're talking about today. It's Thursday. We look at breadth. And short-term breadth getting close to oversold conditions. We're looking at the percentage of stocks above their 50-day moving average for the S&P 500 here. And you can see that we dipped down close to the lows from May, which preceded that June rally. Not saying it has to play out the same way. There have been plenty of instances over the past 2 years where we've gotten lower. Right? I mean, 10 is probably a washout. The lows from back in December were an uber washout. But it's just kind of interesting that we've bounced here from the levels in May. Would also highlight that earlier this week, the percentage of stocks, this is in my note, percentage of stocks above their 20-day moving average, so short term, and kind of the first one that rolled over that started to give us some worries about breadth, actually got down to 11% earlier this week. That's deeply oversold. So short-term breadth, getting close to or at oversold conditions. Here's that rally in treasuries. We have been bullish on this fund. In our market survival guide note, we have been advocating for exposure to treasuries via this product since March. And you can see it's done a good job of diversifying equity portfolios. It's in a steady uptrend above a rising 200-day moving average. RSI throughout the time frame here has been mostly in bullish ranges. Remember, we talk about the ranges for RSI as a momentum signal, right? Routinely becomes overbought, as it is now, by the way. Never really gets below 50 much. So obviously momentum is confirming this price action. At the same time, we're starting to see it outperform relative to stocks. Look at this, or at least breaking the downtrend line that's been in place since the beginning of 2019. Right. Nice downtrend. We've broken above it. So you're getting to the point now where treasuries are outperforming equities. For those of you who run diversified portfolios, that's a good sign. Something that I don't like in the term and why I say I wouldn't chase here is I don't like this reversal yesterday. As we spiked to a new high, we then reversed to close near the low of the day, virtually unchanged. I don't want to chase this here. I want to give this some time to settle out, especially given this massively overbought condition. But from a trend perspective, there's not a lot to dislike about treasuries here, especially the IEF, the iShares 7 to 10 year treasury bond ETF. Finally, in a low vol world, in a high vol world, low vol leads. SPLV, the Invesco S&P 500 low volatility ETF, bullish ETF rating, retakes the rising long-term trend line after holding support at $54 and now beginning to outperform the market again, and has persistently bullish money flow, overbought, oversold indicator in an oversold condition. For those of you who trade ETFs, especially thematic and factor ETFs, I think you should take a look at the SPLV, the low volatility ETF. That's going to wrap it for today. ChakinAnalytics.com/today to sign up for that email. I will be back here tomorrow. Have a great Thursday, everyone. We will see you tomorrow morning.